So, welcome to today's podcast. We're in for another round with our friend Joe DeFazio, enrolled agent and advisor. And we set the table a little bit by providing kind of the foundation around the tax code, right? We're trying to almost demystify the tax code so that it can be your friend, not your enemy. The tax system and the code and can have a negative tone to it, but we're trying to shed light on the positive aspects of it and where we can actually do what the government actually really wants us to do and actually save on taxes at the same time. So, on today's episode, we're really going to focus heavily on the individual employee and the family, right? And we're going to build upon that. But that is at the core for the tax code, the individual making money and just living life. And the unfortunate reality is that because the tax code is used as a means to obviously collect revenue, but it's really an incentive tool that the government puts in place to help guide the economy in the United States. And so, for the employee, there are likely not as many incentives that are put into the tax code because that's not where they're prioritizing. And we'll go into that from investment and business owners and all those sorts of things. But we wanted to lay the groundwork of just kind of setting the course for the tax code itself and what might be sort of applicable to your world. So, Joe, with that introduction, thanks for joining me back on the podcast.
Yeah, happy to be here and thank you for having me. I love that intro. And honestly, it's a great segue from our first video where we talked about the four, purposes of the IRS tax code. And one of them is controlling behavior. It's influencing behaviors. To your point, we elected officials and they got together and decided they have plans and agendas. And unfortunately, the government doesn't control all of labor. So in order to incentivize business, the only thing they can do is give you tax incentives. So they'll give you breaks if you do X. They'll give you breaks over here if you do Y, right? So really, you can look at it and think of the tax code as an instruction manual to follow the government's desired course of action. And along the way, they're going to give you all these breaks. But believe me, the breaks are not loopholes and these like negative spun things. The government needs certain things to happen. And the only way to do that is to incentivize the marketplace to deliver that. It's all legal. Like we said before, we're not trying to end up in jumpsuits and in prison or in handcuffs. But yeah, let's rock and roll. We're going to focus on, go ahead.
Yeah. So let's focus on which is obviously a lot of the tax code is very little of the tax is directed on the tax rates, right? Themselves. It's fairly straightforward what you pay. And so the vast majority is related to, or you call them deductions, adjustments, credits, things that reduce your income and your tax burden. So for someone who's an employee, right, raising family, has homes, whatever. So let's walk through some of the more common sort of deductions or adjustments and credits that people are facing or can take advantage of.
Yeah, and I think before we jump into that list, to distinguish between those three things you just mentioned. So we have credits, we have below the line deductions and above the line deductions or adjustments to income. I start with my favorite. Credits are a dollar for dollar incentive that says, hey, we'll absolve 100% of this dollar of your tax bill if you choose to do this. So a credit is a dollar for dollar adjustment to your tax liability directly. A below the line deduction adjusts your income that still has to, so you still have to pay the progressive tax rate on that income. So although you might get a $1,000 deduction, the impact of that deduction is it's whenever your marginal rate is to your tax liability. So if you're paying 20%, 1,000 times 20% is what's going to offset your income. So it's still good. We still want, to capitalize when we can, but if you can get several credits in line, if you can arrange your affairs where you're receiving credits, that's the way to go. Adjustments are more for, let's say, incentives to save for retirement, save for health. We'll go through a quick list and I'll show you where to look those up. But it's really before you get to the amount of money that's going to be considered taxable, right? So before we get to the tax brackets, we're adjusting the top line down. That's going to be taxable. Then you can get deductions against that to find your tax liability, and then the credits offset the final number. Hopefully that makes sense.
That does. So we're starting at a big number with income, and all these things are cutting it down based on deductions, credits, and then you land with an adjusted number that a gross income number that now is subject to taxation, right? At whatever rate you are at, right? And progressive nature of the tax code. So we're just trying to find ways to reduce it where you can legally. So for folks who are not a business owner or invested in anything that is being incented by the government, so what are the more common things that you might be able to get a deduction or adjustment or credit for?
Yeah, it's okay. I'll share my screen and I'll show you a great resource to stay current with this, because I don't know when you're going to be watching this video. But actually, believe it or not, if we go to the IRS website, ooh,
Everyone's doing this, I know.
oh yeah, everyone checks this every day. But if you go straight to the IRS website, believe it or not, it's the menu right at the top. Credits and deductions. They give you some ideas for popular credits or deductions. But if you go for right now we're talking about individuals, so we'll go to the individuals, and they'll give you a load of great information here. It bifurcates different credits where some of them are refundable. That's a great point, and non-refundable. What that means is if it's refundable, they give you money even if you don't owe any tax. Remember I said it's a dollar for dollar offset. So you get a refundable credit and you had no tax liability. That credit's $10,000. The IRS will send you the $10,000. If it's non-refundable, they won't send anything. They'll say, oh, you had zero tax liability. So,
Yeah.
that's great. You qualify, but there's nothing to do with this. So let's see. We scroll down here. We got, great topic. Standard versus itemized deductions. Most people fall right now into the standard deduction. Now, this could be changing in the next few years. Again, we're in May of 2024. There could be sunsetting certain provisions that would reduce or remove this quite a bit, which means more people would itemize. But for now, here are the thresholds for the various tax filing statuses that if you don't have enough itemized deduction, it makes more sense to just take the standard deduction. This is a freebie. They say, here's the hurdle. If you had more stuff more things that qualify as an itemized deduction, you can do that. But otherwise, we're just going to let everyone take this. For single, 13,850, so on and so forth. And now, as you get older or you suffer certain ailments, they give you additional standard deduction, which we can dive into that maybe at another time. But here are the adjustments to income. So they're calling these deductible expenses, but you can take these even whether you itemize or you take the standard deduction. Remember, because we're at the top of that list, we earned income and we're going to do some adjustments to that income. So we have alimony, we got some business use of things. We put money in a deductible IRA if you qualify, a health savings account if you're part of a high deductible healthcare plan and it's offered. Yeah, there's student loan interest, teachers' expenses. There's a load there. I can pull up the actual schedule. Don't want to overwhelm anybody here, but it shows up on Schedule 1 of your tax return, Part 2. So I'm just going to skip to that page so we don't have to we're not crushed with a wall of numbers here. But here's what it looks like. It's literally that list: educator expenses, certain business expenses, right? So the IRS website is a great resource to try and find a more human way to read these forms. Yeah. And they'll give you a lot of information on how to fill this out. But so there's several adjustments to income to start things off. If we scroll down a little bit further, you can see if you itemize, right? Remember, we need whatever the total of this number is to be greater than the standard deduction to make this make sense. But if you do fall into that category and you're itemizing, you have bad debt, capital losses, donations to charity, gambling losses, things of that nature. Uh, Home mortgage interest is a huge one. SALT, so that's your state and local taxes, whether it's income or sales plus your property taxes. You got medical, qualified medical and dental expenses. Again, they started adding these thresholds in just to curtail how much tax revenue they're losing by giving these deductions, but it has to be above a certain threshold of your income or they won't let you deduct it. The total does, not one individual expense, but the total of all your expenses do. Yeah, and those show up. See if we can get this right. That is set up. Oh, skip to credits. Sorry. Here.
And the main
There you go.
ones, especially for folks who have kids and actually own a home, right? They're related to the itemized versions are the interest you pay and right and what you're paying on a state and local tax perspective and cost for kids, right? Because they want to help support that families and people living in homes, buying homes, right? So you could easily see the connection point that they want you to do that, right? Because there's more people, more active economy, and so they're gonna help you in some respect, right, from a tax liability.
Yeah, and great point. All this ties into certain economic theory, like it's called I believe what is it? The wealth effect, where if you see your assets growing, you're more likely to spend. And because America is it's a consumer economy, it's a debt-based consumer economy, they need people to spend. So one way to encourage spending is indirectly say, oh, get these assets because these assets tend to appreciate, which makes you feel wealthier. So you feel comfortable spending. Great point. Here's the itemized deduction, and they do a good job. On the left-hand column, usually there's a header that everything's under. You can get lost in the sauce if you're trying to go line by line. But if you follow the headers, this is the medical and dental. This is the SALT, I said, state and local taxes. Interest, this is home mortgage or qualified second mortgage interest. Now there's thresholds there. You can't just go out and buy a $1 billion house. They limit you to a certain threshold, which changes each year, but most people fall well with underneath that. So you get credit there. Gifts to charity. If you do any type of donation, like clothing, things of that nature, if you give to your church or anything like that, or any type of religious organization, that'll show up here. Casualty losses, if it's from a federally declared disaster area. Yeah, this is most people. These are the big four: medical, SALT, interest, and gifts to charity are the most common deductions that you'll see, and they show up on this Schedule A. So if you're trying to see where we are in your tax return, it's usually after your 1040, the cover page. Schedule 1, 2, and 3, usually then it's Schedule A. So that's good for the itemized deductions. If we want to talk a little bit more about some of the credits, as Tom also said, like starting a family, it can be expensive. Kids and the expenses around kids, it's expensive, but they give you certain tax credits. So the main one for most people, it's going to be, we see the credit for child and dependent care expenses listed here. So that's huge. Again, that's for individuals. If you have a dependent, you have to meet certain criteria for it to be considered a dependent, so a direct child. And then you can have other people that qualify as a dependent. So like maybe a parent or something of that nature. But again, there's criteria to qualify there. They give you several $1,000s. It's again, we're kind of in a weird area where they're talking about changing that right now, but they give you several $1,000s as a credit. Remember this, right? This offsets the liability. It doesn't offset the income. We love credits. And here's just several of them. If you make an improvement to your home, but if you make under a certain amount of money, you can claim that you also saved for retirement. So they'll give you a credit for the money that you saved. If you try to make your home more efficient, like maybe you bought a more efficient HVAC system or a heater or something of that nature, they'll give you credits there. If you, what qualifies for the childcare expenses? So if you send your kid to some type of institution where you have to go to work, so they're watching for your kid, they're watching your kid, you can deduct those expenses. And the list goes on here. So they give you several credits. And if you can structure your year, like if you're going to buy an EV or something of that nature, like they give you credits for all this for now. Um, Solar panels, things of that nature are another big one that show up a lot. The adoption credit shows up a lot. But yeah, generally your accountant's software is going to run your numbers through all this. They'll ask you a bunch of weird questions every year. The reason they're asking you the weird questions is because they're trying to find any of these things that match up with your situation. And if they can get you the credit, most of them, or the software at least, is trying to get you as many credits as possible. So hopefully
Yeah, that makes
that's
sense.
helpful.
And to your point, and I really like the way you shared this because the IRS is not trying, people would sometimes ask, so where are all those hidden loopholes and things that are hidden away in the cave somewhere? Well, when you look at it the way you've just shown it here on their website, you look at the details, the software will ask these questions. They're telling you the cheat code, right? These are the things that will help you if you do these things, right? You may not want them or need them or such, but it's not like this is some hidden behind the scenes. Now, there are certainly more sophisticated things as we move along in this series. But at its core, a lot of them are pretty transparent. You just have to ask and look, right? They're just sitting in plain sight. So is that an accurate description?
Yeah. Yeah, Tom, that was great. I think to your point earlier, when you first introduced this topic, you were saying we're kind of in our own, it's a smaller sandbox, a smaller bubble. There's only so many levers we have to pull, but they want you to pull them, right? If you're going to buy a house, they want to incentivize that for you, right? If you're going to buy a car, they want to incentivize the EV instead of a gas. Like, yeah, you got it spot on. It's a shame. It's like people look at this with like more fear and mystique. Yeah. Maybe they need to hire some type of web developer to make their website more friendly or something, but it's there if you search for it. And you always have professionals you can call. CPAs are great enrolled agents. If someone's in your area, that will go down that rabbit hole with you just to see how much of this can we utilize and take advantage of. And that's not negative connotation. That's literally, there's no rule that says you're not allowed to claim the child care credit, right? It's in the code. That's the law. It's in the code. It's there so you can claim it. So please explore it. And if you meet with a financial planner, what they can do is they can help strategize with you. If they're involved with your tax professional, like for example, a big one recently was donations to charity. If you, as an individual, if you're making like smaller donations over time, instead they could say, okay, is there a way we can do this in one big chunk so we can itemize in one year and then take standard deduction in the next and itemize in the next? So in a way, you're getting much more of a deduction comparatively, which, like we
That
said,
makes sense.
all of it helps. All of it helps. But you want your team working together around this, right? Because man, it is a mess. It's 6 to 8,000 pages. It keeps growing. It just keeps growing. And it gets crazier and crazier each year. And they change the forms over time. Yeah. So ironically, all the IRS really cares about is when you claim something, they want it documented properly. They want your proofs, right? If you took great notes, great logs, document it properly, make an earnest effort to do this correctly, they're not there to get you. They're not trying to get you. If anything, they're a good resource to figure out how to do it. Yeah. If you got the right people on your team, it's night and day difference.
Well, it's just like anything, planning is necessary to help you kind of get ahead of these things and think through them. Right. That's why meeting with a professional is helpful to ask these sort of questions. And as your world gets more complicated, right? More things may be opening up, right? But you got to ask and inquire. So the one kind of shifting gears a little bit. So that was really good around kind of defining some of the key deductions, credits, adjustments. And the other aspect, I think, around tax savings, quote unquote, tax savings, because I always hesitate when I say this, but most people think about retirement planning and contributing to these sorts of qualified plans or that the government has created. So that is typically what most people are thinking of when they're tax planning as an individual. So let's talk about that a little bit around like 401ks, IRAs, any other kind of miscellaneous retirement accounts that kind of smell like that, like 403bs. Interesting enough, and this I know you know this around the sort of the background of it. Like, how did any of this even evolve? Because I feel like it's always been here, but it really isn't that old, really, when you really peel it back.
Yeah. So, someone pointed out to me as I was saying this that a 401k is not even old enough to retire. The invention of the 401k, or I say discovery of the 401k. Yeah. So, wow. So that's a great topic. So I think you have to approach this for a couple different ways. Usually it comes down to two different ways. One, you can look at things to say, how do I reduce my tax liability in any one year? How do I maximize that? Or, which I take the second, but you take a longer term view, your life, maybe the life of yours and your spouse's, yours, your spouse, your kids, your grand, like a longer term view. And you say, how do I minimize my tax liability, like over the entire time, permanently, in essence, for multiple generations? How do I reduce the total tax liability? The 401ks, the IRAs, the SEP and simple for small business and self-employed people, 403bs, these are all sections of the IRS code. So they were invented and created from the IRS. And they're designed with almost like 1 year in mind. If I make a contribution, I get a tax deduction, right? What people don't realize is that it's not, you're completely mitigating the tax. You're delaying the tax. It's tax deferred. You're delaying the tax into some other time period with some other administration, with new rules, with a rate you don't know. And then the tax risk can't be understated, but you get the deduction now. The alternative is you can pay the tax now and have a defined future, like what to expect. So what I'm alluding to is a traditional compared to a Roth. If you are considering a short enough time frame, a traditional 401k, 403b, a traditional IRA can make more sense. If you're only thinking your lifetime for 20 years and your retirement, yeah, it can make sense. When you start adding in, this is going to be transferred to my next generation during their peak earning years. Like when you start adding in the tax liability, you just pushed to the next generation. It's not as beneficial as you might think. Um, so
It is quite amazing. That it's become kind of just the full retirement vehicle for most Americans, and it wasn't started off that way, right? It was designed back in the what was it, 70s or 80s, and
yeah,
and it was when tax rates, people probably can't even believe it was 70-80%, something in that range at the top marginal tax bracket. So at that time, it obviously made a heck of a lot of sense. How do I avoid having to pay that? And maybe in the future, they're going to change tax rates and lower them. Like we are living in fairly low tax rates today, even though it doesn't always feel that way, right? But when you look historically, we are pretty low. And so you got to play that game to understand that we don't know what tax rates will be in the future. So that's a risk, right? You may end up paying more or less. Don't know, right? If you actually do the math, right, Joe, if tax rates stay the same today as they are, if you're paying the same tax rate now versus when you go to utilize these dollars, it's a wash. right? It won't actually save you any money in general. It's going to be an equivalent sort of feel, right? An impact. So the story goes that I'm going to be in a lower tax bracket when I'm older. Well, maybe is the appropriate answer. You don't know, right? There are certainly strategies around it, but there's no guarantee of that, right? Like a credit you take, I'm going to save taxes today.
I'm trying to think through your example. It's please, as you're watching this, it's a very simplified example. To say, you have to say not only the tax rates, but the entire tax code remains the same.
Mm.
Why I say that is because the IRS, the government, the governing bodies create new taxes. Like they're not limited by the rate you're paying. Yes, they can adjust the rates, obviously. They can condense the brackets. If you condense the brackets, more money gets pushed into a higher rate without having to change the rates, right? If you change the rules on RMDs to say you need a bigger percent to come out earlier, well, that means there's more income, which means a higher rate. Whether you need it or not, it's required minimum distribution, right? So they have all the levers, right, to change this. And people tend to only go, oh, well, the rate of this and the rate of that, when the reality, if you do the math, to your point, believe it or not, there is a break even point. So a Roth is a 0% tax rate in retirement. The traditional is, we have no idea. It's going to be something. It's something is always greater than nothing. So there's a point where the amount you saved, like in your contributions per year, compared to the tax liability you created in retirement, let alone the later on stuff. It's like there's a break even year. So it's a very complicated thing to try and figure out which makes more sense. And that's why I started by saying you have to decide what time frame you're going to look at first. And then you have to accept the idea you're saying the tax code's going to be the same all the way. The only thing we're changing is tax rate. And I'm hoping that's at least the same. And then it's a wash. Okay, sure. But if you're saying it's going to be the same or less for your life and your kid's life, and like you can't see that. Nobody can see that far in advance. Anyone who's telling you that, it's ridiculous to think you can tell what's going to happen 100 years from now. That's silly. Even Ted Benna, I think, is the father of the 401k. He discovered it in the 78 Revenue Act, I believe. And he put the first one in place, I think, in 80. But it was more of it's a deferred comp plan. I forget the exact name, but the name was so bad, nobody wanted to do it. So he had to write the first one himself to show people that it actually worked. But yet you have to think through quite a bit. It's not as simple as what rate versus what rate. You're oversimplifying the problem. Dramatic. This can all change. Again, the whole thing can change. But right now, qualified distributions not only are taxable, but they count as provisional income, which makes your Social Security tax, which hits your Social Security benefits. So that tax has to be added into the equation, right? It boosts your capital gains tax. You could be pushed into the 15 or 20 or 23 or 25, soon to be 25%. So you have to add the whole tax liability in and say, which makes more sense? Do I want to pay more or less? And
well, that's why, to your point, the time frame does matter, and thinking kind of future wise, how you're going to access and utilize your assets are so key. And we're going to spend some time in this series too down the road talking about investments and sort of even retirement, because the game will change, right? Life will change in that respect. And we don't know what will look like 20, 30, 40 years from now, right? The tax regime, kind of lifestyle, the economy, all those things. There's so many unknowns, but at least having an idea of where this will go will help you at least in your planning, right? And that's why it's so key. So it's really important to sort of frame it, because we can easily fall prey. And certainly I was there at one point that, hey, I'm going to put money into this and I'm saving taxes, so it's all good, right? In that
Yeah.
year, that is absolutely true, right? And especially if your company is providing a match to what you contribute, definitely there's some certainly benefit to that. But I really would want people to really take to heart the sort of broader picture of it, how Joe describes it, because it is way more complicated, even though they want to simplify this. And people are not as aware what it might look like down the road. And so we're going to cover that later, but suffice to say, there's a bigger picture here. So the last topic I want to maybe touch on briefly is around a kind of big thing that certainly for folks with kids and or aspire to have kids is saving for college. It's one of the biggest expenses outside of maybe the home that a certainly family has to deal with. And how do I save for college? Right. So that usually comes up. So one of the biggest things, right, when we'll talk about it is what the 529. So let's walk through a little bit of that and kind of maybe quick snippets of what that looks like, the pros and cons of them.
Yeah, absolutely. So high level of 529 is another section of the IRS code. Anytime you see those numbers or the letter or something like that, like it's probably part of the IRS code. So it's going to come with similar red tapey feel to it. So there's qualifications, there's limits on how much you can pay each year, there's limits on how much you can pay in total. But generally, you would take after tax dollars, contributing into a 529 up to the annual gift limit. There are certain extra provisions where you can get more in under certain circumstances, but they limit your ability to contribute in the next few years. But the money grows. In theory, you can either have a prepaid tuition plan or an investment plan. If you choose the prepaid tuition, you're paying today's rates. There's probably a premium on them, but you're paying today's rates for 1 year. So if you put whatever it is, $5,000 in that you want to pay towards education this year, that goes in as this year's rate. And the theory is tuition rates just keep going up. So if I can pay them now while little Susie and little Johnny are, you know, 1 or 2 years old, and we're done paying by the time they're 8, it's like, okay, problem solved. They have the equivalent of 120 credits that they can spend at their college. So they take dollars out of the equation. You're removing the dollars out of the equation. You're giving credits. The other option is an investment plan where it works similar, kind of like your 401k. There's money that goes, you contribute, you own and control the account, even though it's for the benefit of your child. You can have one on yourself too, but usually people are doing this for their kids. And you control the investments. So you can say, I want it to be in the S&P 500 or something really aggressive, or they even have the target date mechanism where they'll say, as you get closer to at college or matriculation, it switches to a more bond or cash heavy portfolio. So you can pay the tuition bill. Important note, again, I said earlier today, documentation. So when you're when you're contributing, you should document that. There should be a tracker you keep. Number two, when you're taking distributions, you have to keep your receipts. They want to see a matchup of expenses to the distribution to the penny. If you took 15,000 and can only show that you needed 10 in qualified education expenses, that other 5 is not a tax advantage distribution. You're going to pay some penalties there, 10%, so on and so forth. So it's not a set it and forget it plan, although I think it's improved quite a bit in the past, probably 10 years, but you still need to track a bunch of information with it. Generally, it's tax advantaged while the gross, all of it is tax advantaged. You don't have to pay taxes each year. So that's, again, a tax deferred. If you take the money out for qualified education expenses, it's completely tax free, meaning you put the money in, it grew. You didn't have to pay any income while it was growing, income taxes while it was growing. When you took it out, all of it is ignored as far as your taxes are concerned. It's right now, it's the elephant in the room that can do the heavy lifting for most education planning. And they've opened it up. It's not just for college, grad school, trade school, private school, if your kids are going to some type of private school earlier on. So definitely you can do this for a lot of education planning. and they can be passed. So if you had $100,000 left in your 529 from Johnny, and it needs to go to Susie, you can change the beneficiary. Again, there's certain rules on who you can change it to, and there's certain rules on how many times you can change the investment strategies throughout the year or do rollovers throughout the year. But generally those are the basics.
No, that's great. That's helpful. And it kind of, from my perspective, when I look at it and thinking it kind of has a similar feel to like a Roth we're using after tax dollars, right? And a gross tax deferred and can come out tax free if used for the right purposes for education. And you can even get for some states, a deduction for your contribution. So it kind of has that little added bonus there from a state level if you are in a state that has state
Uh,
taxes, right?
yeah. Well, I was going to clarify. It's where you live. So you can get any state. You don't have to use your state's 529 plan. But if I live in Pennsylvania, Pennsylvania has a deduction for contributing to any 529 plan. And I use, Florida. I'm just picking that up. I'm just picking another state. If I use a Florida plan, for example, I still get a deduction for Pennsylvania state taxes. It has nothing to do with the Florida state plan. I just
Right.
wanted to clarify, like, you can't live in a state that doesn't offer a deduction and be like, I want the Pennsylvania state one, so I get a deduction. It doesn't, it's your state has to offer the deduction.
Yeah. So those are, I mean, there's definitely a lot of pros to these type of plans, and some of the negatives I've seen too is maybe there are, depending on the plans you use, there are maybe some restrictions on what you can invest in, right? It's going to be primarily market based type assets, and the challenge too I see sometimes too is that, and I heard this the other from a friend, you had to liquidate it, and then all that money now is gone forever from their family. Now, obviously, you're investing in your kids or yourself, depending on the setup of the plan. But now all the money that you've been building now is basically handed off to the educational uh, group, right? The college. So that money now leaves your
Personal
control
economy, right? Yeah,
yeah,
yeah.
forever. So it's a financing strategy, certainly that needs to be accounted for, but there definitely are some benefits to it for sure.
Yeah, it's definitely, that's a great way to put it. It's like if you're it's a cash financing strategy, right? We're going to try and self finance this through cash and hope appreciation. But one thing we should note, recent changes, you're allowed to exchange a portion of your 529 to a Roth IRA, the beneficiary is. So in that scenario where we had $100,000, maybe they can take 25, I believe it's up to 35 for this year, to convert to a Roth IRA and then give the rest to Susie. So they can get little Johnny is going to get a good jump start on his retirement planning. Just something to keep note of. But to your point, the bigger question, like I brought up the timeline question with the Roth versus traditional. Tom's question is great. It highlights the idea how much of your money you lost control of if you do this strategy. Is there a better way for the order in which you use this strategy where you may not lose as much of your money, control of your money? Um, but yeah, that's a great point.
Yeah.
Always thinking,
So
Tom.
no,
We're
it's
always
a
thinking.
great. Well, this is really good, and like I think we've covered a lot of ground in this episode individually for individuals, right? And we're going to go as we move along the path of this series into unique investments and business owner. But for the core individual that maybe is with a job, family, I mean, there's a lot of areas that you can be saving some money in your taxes by doing the things that you already probably want to do, and some of them just takes a little extra planning and maybe talking with your accountant to walk through it, but plenty in there. So, Joe, I really appreciate it. Great stuff again, always. And we'll be back for another round of this to go deeper into those other areas. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.